Okay, so in this video I'm going to demonstrate how to create a manufacturing budget that consists of sales budget, debtor budget, materials, labor, variable overheads budget, a creditor budget, a capital expenditure budget, a fixed overhead budget, and a cash budget. So awful lot of different budgets to create, and then finally we're going to do a master budget down here where we're going to summarize our total budget. So what we also need to be able to do so is we need to understand how much we estimate to sell each product for and what our standard cost is. So if we just remind ourselves, the standard cost is what we believe each product will cost to make. And down here we can see we think it's going to cost £12 to make. And we think so because we need 4 planks of materials of £2 each. So 2 times 4 is 8. Labor, we need to spend half, or a person needs to spend half an hour, and we're going to pay that person £6 an hour. So 6 times half is £3. The variable overheads, we need half of that times £2 for a variable overhead. So 2 times half is 1. Add the 3 together, it gives us a total standard cost of 12. We also need to appreciate that the items I've highlighted here in yellow are estimates, so those are budget figures that we are given. There's also one down here in the creditor budget. But anyway, let's get on with it. So a really important thing to appreciate when you create a budget like this is that the sales budget is the driver. And what is meant by that is that the sales budget is the budget that helps drive the values that is in each of the other budgets. So these budgets, what we think will be in them, becomes bigger or smaller based on the size of our sales budget. So we are given in this particular exercise a number of units that we expect we're going to be selling throughout each of these months. We think we're going to be selling 60,000 units in August and 70,000 units in September, and so on and so forth. But let's get to it. Let's create the budgets. So firstly, let's have a look at the sales budget. So the first item to create is the forecast sales in pounds. So we know that we're going to sell each product for £20, says so down here. And we know that in August it's going to we expect to sell 60,000 units. So the total income or revenue we expect is going to be equal to the 60,000 units we expect to sell times by £20. That's what we estimate we're going to sell each one for. And so we get an income of 1.2 million. We can now, because we've already done this formula, we can simply just drag it, and that's going to give us the same. So this is 20. This is equal to 20 times the 7,000 units we expect to create. So the next budget is the debtor budget. And the debtor budget is effectively a budget that shows how much we expect to owe our debtors. So, that our debtors will owe us. In other words, our debtors are our credit customers, or customers who's bought on credit from us. So it's fundamentally going to show down in the closing balance here how much our customers owes us in the end of any given month. So we start out, we've been given our starting figure of £30,000, and what that means is that in the beginning of August, our customers owes us £30,000. But in terms of our sales, we expect to have sold to them £1.2 million worth of sales. So all we need to do is to lift these figures down here to actually show that we expect to have sold all of that value to them. So in Excel, the easiest way of doing it is to say that this sale is equal to 120 or the £1,200,000, and that gives us this figure here. Doesn't look, it's not very easy to see, is it? So let's just change it to that. What we can do is we can literally drag all of these values over here, so we can see these values just feed from here down into our budget down here. The subtotal is simply just our opening balances. So our opening balance added to our sales for this particular month. So we're in the month of August here. So that would be our opening balance plus our sales of 1.2 million. So in total, we expect to, at this point, that our customers will owe us £1,230,000 so far. But now we got these yellow items. Let's just remind ourselves, these yellow items are estimates. So this is numbers we've given. This is what we expect would happen. So in terms of receipts, well, what are receipts? Well, receipts are simply the money that we expect our customers to have paid us during this month. So we expect to sell a certain amount to them, but we also expect them to have paid us for that during each month. So in total, in the month of January, we expect to be paid £100,000 by our customers to settle their debts. In September, we expect it would be 105, and so on and so forth. Bad debts is the money that we will not receive from our customers. For example, we might be told by some of our customers, one of them, that they're gone bankrupt and they simply won't be able to pay us, and we know that we can't get this money back. So that is unfortunately a reality of doing business and selling on credit. So we've also made a budget for each month where we expected that we won't receive these items. So in August, we're going to write off a debt of £5,000. In September, we're going to write up a debt of £7,000, and so on and so forth. So let's use all of these items here. So what we need to do is we need to be able to calculate the closing bank balance. So up here we had our subtotal of £1,230,000, so that's what we expected that our customers to owe us now. But if they pay us in the month of August £100,000, well, actually we need to say, well, they paid us that £100,000, so they don't owe us that money anymore. So we're going to subtract that. And in terms of bad debt, well, we're not going to see that bad debt, so we're going to write it off. So we need to subtract that as well. So the closing bank balance is going to be equal to our subtotal here, how much our customers owe us, minus the money they have paid us, minus the bad debt that we're not going to see again. So now they owe us £1,124,000. So our closing bank balance is how much our customers owe us in the end of the month. And if that's how much they owe us in the end of the month, in the beginning of the next month, if nothing else changes, they're going to owe us the same thing. So what we can do up here in Excel is we can say that this cell is equal to this cell down here. And if I do that, we can now see that we start out the month saying that our customers owe us this amount here, which is the same as how much they owed it in the end of August. And what we now can do is we can simply just, because we've done the formula, we can drag this across. We can also drag across the subtotal that we got here. So we calculated the subtotal to be the opening balance plus the sales. So that's this one here. We can drag that across. And finally, our closing bank balance, we can drag across that as well. And when we do that, we can see that our debtor budget grows and grows and grows. So we end up the month with being owed this amount of money. And that's what we're going to start the next month with. We expect to have an income of this. It comes up from the sales budget. Add the two together. That's going to give us our subtotal. We expect to be paid this amount of money, and we expect to write off this amount of money. So we subtract those two from our subtotal, and that gives us our closing balance, and on we go. So that's how you do a debtor budget. Materials, labor, and variable budgets are all calculated in a very similar way, but it's quite different to the debtor budget. One thing they do have in common though is that they're all driven on the back of the sales budget. So to work out our materials budget, we need to know two things. We need to know how much we expect to sell. So that comes up from the sales budget. And we need to know what our standard cost is. So in terms of the material budget, we can define how many units we expect to need to purchase based on our sales. So if we expect to make 60,000 products, and we know that each product needs 4 planks, so that's the materials, well, the total amount of units that we're going to need in this case, so planks, is 4 times the number of units we are actually going to make, which is 60,000 units. So in terms of materials, what we are basically saying is we need 240,000 units or planks to be precise. We can drag this across to find what they would be in the other month. In terms of the actual material cost, well, we can see that each plank costs £2 to make. So what we can now do is we can simply say, well, each plank costs £2 to make, and we need 240,000 planks. So all we have to do is to say 2 times our 240,000 planks. That gives us £480,000, and we can drag that across again. In terms of our labor budget, what we're trying to work out is how many hours are we actually going to need to spend on this product. So we can see that our labor, it takes us half an hour to make each product, and we can see that we need to make 60,000 products. So the total number of hours we're going to spend here is we're going to need to make 60,000 products times by half an hour. That's how much time we're going to spend. So in total, we're going to need to spend 30,000 hours making this product. In fact, I'll probably make this a little bit simpler. Instead of making the reference here, I'm just going to say 0.5. So still half an hour times by our forecasted sales in units. It's the same thing. What we can do now is to drag it across like this. In terms of how much it will actually cost to make, again, if we make, if it takes half an hour to make it, and it's £6 per hour, and we are making, or we are spending 30,000 hours, all we have to say is we're going to spend 30,000 hours making this product times by £6 per hour. That will give us a total cost of making these products. And what have I done wrong here? I should probably just say, instead of using that reference, I'm just going to say times 6. It's still the same thing, £6. And let's drag it across again. So we get this. The variable overhead budget is, we need half of that. So if we again are saying that we're going to make 60,000 products times half, that will give us 30,000 units of variable overheads, and we can drag that across. In terms of the cost of making this, we could see that each sort of unit of this has a cost of £2. So if we make 30,000 units, we can say the 30,000 units times the £2 that they cost to make, and that gives us £60,000, and we can drag that across. And as such, we've now created all of the 3 sort of budgets that relate to the cost of making the products. Creditor budget. So the creditor budget is very similar to the debtor budget. So the creditor budget or a creditor is someone that we owe money as a result of having bought materials of them, or bought stuff of them. In this case, it's materials, and we bought it on credit, so we owe them the money. So what we can see down here is we're being told that as we start out in August, we owe our creditors £125,000. And like with the debtor budget, what we need to work out is the closing balance. So how much will we owe our creditors in the end of August? That's what we need to work out. Well, first of all, we need to work out the purchases. So the purchases is coming from our materials. That's us having to have bought those materials. So we can see here that in terms of our materials, we expect to need to buy £480,000 worth of materials down here. So all we have to do is to effectively say our purchases here are equal to how much we calculated in the materials budget up here. Let's just turn it into something a bit more easy on the eyes. So in August is 480, and because we did it as a formula, we could just drag it across. So we can see that in our creditors budget, we expect in September to need to purchase £560,000 worth of goods or materials from our creditors, which effectively have come from straight up here. It's sort of like lifting it from here down to here, from here down to here, so on and so forth. The subtotal is simply calculated by saying your opening balance plus your purchases. That's your subtotal. So in other words, with the subtotal, what we are saying with it is that we expect to start out the month of August by owing our suppliers £125,000. We also expect to purchase an additional £480,000 of them. So in total, we expect them to owe them £605,000. But we also expect to pay them £125,000 in the month of August. So actually, we're not going to be owing them £605,000 when we have paid them that amount of money. So our closing bank balance is going to be our subtotal minus how much we already have paid them. That's going to be how much we owe them in the end of the period. So our closing bank balance, actually I can just move this, copy this all the way across because it's going to apply for each month. And the final thing to simply do is to work out what the opening balance will be for the next month. And it is simply like with the debtor budget, the opening balance is going to be the same as our closing balance. So the opening balance will be the same as the closing balance, given that nothing changes, and we assume that it won't. So our opening balance is going to be the same as our closing balance. We can now drag that across as well. Okay, so that's our creditors budget. We got down here a couple of other budgets, so a capital expenditure budget and a fixed overhead budget. So capital expenditure budget is how much you would expect to buy each month of machinery, for example. And let's just add them all up. So we could go up here and we could say AutoSum, just add them all up and drag it across. So here we've now got an idea of how much we expect to spend each month. So each month of August we expect to buy machinery worth £205,000, and in terms of November we expect to have, add the two together, purchase machinery worth and vans worth of £4,370. Our fixed overheads are just that, our fixed overheads, and we're given them in this task here. So we don't really need to do anything other to appreciate that that is how much we expect to spend on our fixed overheads, like rent, insurance, and all of that sort of thing. And that brings us down to our cash budget. Our cash budget is another word for a cash flow forecast. So what we're looking at here is how much we expect to have coming in to our bank balance, going out of our bank balance, and fundamentally have left in our bank balance in the end of a month. First, what we can see is we got our income section up here, and we've got a total column here. We got our expenses section here and a total column, and then we got the bottom section down here, which is our the section that explains how much money we got in the end of each month. So let's start by doing the income section. So we had an extra income here of £10,000, and we're just given that, so we'll leave that. But we also got credit sales receipts. Now the credit sales receipts is a bit of an interesting one, because what we're saying here is how much money have you physically received? Not how much money do you expect to earn, but how much money have you physically received? And we get that from our debtor budget. So that's this item up here, receipts. Okay. So in our cash budget, we expect to have received, I'm just going to say equal to, we expect to have received £100,000 from our customers. So I'm going to click on that cell and click enter. And I can just drag that along now. And I should probably say this is calculated automatically, but let's just have a look at how you do that. So what we want to see you say with the total income is just that we can add these two together. So if you go to home, AutoSum, add each item together, click enter, and drag it across. It's going to give you the same thing. This doesn't look great on the screen, so I'm just going to change it to that. So here we can see our total income from each of the months. So money physically coming into the bank account, being paid into our bank account. In terms of our expenditure, we expect to have paid out some money from, in terms of labor, to have paid out some money from variable overheads. We expect to have paid out creditors. We expect to have paid out fixed overheads and for capital expenditure. And I should probably say that for each of these budgets, we're just assuming that we're not paying on credit. We're not getting any credit, so we are paying straight out immediately when the expense happens. So the labor budget for August, if we go up to labor, we expect that we're going to spend £180,000 in August. So all I'm going to do is I'm going to say that this cell is equal to our labor budget for August is we expect to spend £180,000. And I can now drag this across. So again, in September, we expect to spend 210,000 or pay out £210,000 in labor, because that's what our labor budgets are saying up here. So basically copy that row down to here. Variable overhead, exactly the same thing. So we expect to pay out for variable overheads £60,000 in the month of August. In the month of September, it's going to be 70, month of October 70, so on and so forth. So we can just drag that across again. Creditor budget is a little bit more interesting, because with the creditor budget, creditors, people we paid or suppliers we have bought stuff off on credit. What we're physically looking for is how much will we physically pay our suppliers or creditors in each of the month, and that figure or those figures we find in this row down here. So this is how much we physically expect to pay them during those months. So this row here we got to get down here. So we're going to say that that is equal to this £125,000 in August, £440,000 in September, and so on and so forth. So we can drag that across. That will give us that. Our fixed overhead budgets are simply given to us up here. So again, we can take this whole item and just move it down there. And our capital expenditure is given to us here. The total is noted here. So again, we will copy this whole item down to here. So that's equal to, so in the month of August, we expect to spend £2,500. That's what's here. And we can move this along. So now we got our total income for the period, or our total money coming in for the period. We got our total money being paid out in the period. And what we then lastly need to calculate is our money in the end of each of these months. We're given as a piece of information that we expect to start out the month of August with £800,000. So what has happened during the month? Well, we have had an income of £100,000. also, sorry, not income, we had £100,000 being paid into our bank account. We also had to pay out £370,000. And that is effectively our surplus and deficit. So our surplus, so money left over, or deficit, money we haven't got our money too little. The deficit is, in this case, £100,000 minus the £370,000. So the net effect of having £100,000 come in and pay out £370,000 is that we are out of pocket of £270,000. And so our closing balance is equal to our opening balance plus our surplus and deficit. So what we are effectively saying is that we started out the month having £800,000 in the bank. We had a deficit as a result of that month's trading of £270,000. So our cash levels are going to reduce by £270,000 down to £530,000. And what we can then do now is we can simply take these two and copy them along. But we also need to calculate the opening bank balance, and the opening bank balance is simply like with the other opening bank balance, is the same as saying our opening bank balance is the same as the closing bank balance from the previous month. So we can take that and we can drag that along again. And what we could then see is that every month we are having a deficit of money, so we are spending much more money or paying out much more money than what we got coming in. So we've got these big deficits in each period, which basically very quickly drains the cash balance. So in the end of January we had £530,000 left. Come into September we've got minus 81,250, and so on and so forth. And finally what we're going to do is we are going to calculate our master budget, in other words our master budget for our profit and loss account. So what we're going to do here is we are going to calculate our revenue. So our revenue is simply, for this period, is simply going to be all of the months added up together. That's going to be our total income. So what we're doing here is we're just summarizing all our accounts into a profit and loss account type layout. So it's equal to okay, I've just moved this item over here. Now, in turn, we also need to calculate our cost of sales, which we can calculate by using all of the three items that relate to calculating the actual cost of making the product. So that's the labor budget, how much it costs to make the product in terms of labor, in terms of variable overhead, and in terms of materials budget. So let's start with the materials budget. So again, we are just summarizing the total cost we expect of materials for this period. So that is equal to, and I'm going to do a sum of that, so equal to a sum of all of the materials. We're just going to add up all of the materials. That's what we're going to get down here. Our variable overhead again is equal to, I'm just going to do a sum. I'm just going to add them up. And labor budget again equal to, I'm just going to do another sum. We're going to add up our total labor for the 6 months. So what we can then do is we can calculate our gross profit, and that is simply calculated by saying our income minus our labor, our variable overhead, and our materials, and that will give us £480,000. Then we got our fixed overhead budget. So that's our fixed overheads. That is simply equal to, and we're going to do a sum again of all our fixed overheads, which is this. So our net profit is going to be our gross profit minus our fixed overhead, and that will become our net profit. So in total we can see that we expect to have spent or have made a profit of £4,060,253.